Hello, from LPL Financial. Welcome to The Talking Point. I'm your host, Quincy Krosby.
Good morning, everyone. It's Quincy Krosby. This is The Talking Point. It is Monday morning, and it is June 27th. I'm doing this call before the market opens, and it looks like we'll have a good start to the market. One of the things that is emblematic of a week as the quarter is closing is that you typically have what we call rebalancing, portfolio rebalancing. Advisors do it to some extent. And then on a larger scale, we get pension fund rebalancing. And what happens is volume comes into the market as you see selling and buying. Now, where are they going to go? Well, that's a good question. But when you have had a quarter of tremendous selling, despite last week's gain of about 3% in the market, typically you will see the allocation move towards that which was hit the most. So we are going to be watching for that, but it could be, and notice I say could be, a catalyst for this market to maintain the upward bias that we saw. Also, I want to mention something from last week, which I consider to be extremely important for this market, and that is the consumer confidence report. Now, you may think I'm kind of crazy with this because the number on consumer confidence was terrible. Consumers are losing their confidence. However, embedded in that report that came out on Friday morning, 10 o'clock Eastern, this is the University of Michigan Consumer Sentiment Report, was something that the market was waiting for, and I should say with bated breath. And that was the picture that U.S. consumers have about inflation over a 5 and 10 year period. You may recall that one of the main reasons that the Fed did an about face during a blackout period just before the Federal Reserve meeting, the last one, and went from 50 basis points to 75 basis points, had to do with the CPI Consumer Price Index that came out, showed inflation moving in the wrong direction, but also the preliminary University of Michigan report in terms of consumer sentiment had the expectations for inflation rising from about 3.1% from the report before to 3.3%. That got the Fed's attention. Why? Because what it indicated was that U.S. consumers were factoring in higher inflation over the next 5 to 10 years, which is not a good thing. It becomes entrenched. And once inflationary expectations become entrenched, it's hard to bring it back to a level that is perhaps more normal and indicative of where inflation really may be. Now, one thing I do want to add, and that is in the Friday report that came out this past Friday, take a look, and I watch this every single minute of the day, of how the market just pushed up the minute this report came out. And why? Obviously, the consumers are unhappy. You think that would push the market down. No, but would push the market up even more than it was as it came into the report at 10 o'clock on Friday morning, this past Friday, was this: that inflationary expectations over the next 5 to 10 years had come back from 3.3% to 3.1%, where it had been for some time. That was considered extremely good news in the market. Why? Because it means that we are not seeing an escalation of inflationary pressures over a 5 to 10 year period. This is exactly what the Fed wants to see and what the market wants to see. So that was extremely good news for the market, despite the overall kind of terrible sentiment report that we had. Now, also, I do want to point out that what we're also seeing, and we've heard it from a couple of Federal Reserve speakers, is they think the market has gone a little bit overboard in the worries over recession, and you're hearing that. But nonetheless, there is a tug of war in this market between those who think, look, we are going to slow down. That doesn't mean we're headed towards a recession, versus those who say, there's a recession coming, maybe we're even in it. So the market has to find an answer. Now, remember, because I know our clients are talking about it, we don't know technically when you are in a recession for many, many months. And we always used to joke when I worked on the other side of the market, on the trading floor, that you find out that we technically went into a recession on such and such a date. But it was so long ago that the market is already up and forgotten about it. So we will be watching all of the numbers that typically lead to a recession. So far, still, the labor market is healthy. Even though we are seeing hiring freezes, we are seeing layoffs, but nonetheless, it still remains solid. If that starts moving much higher, you're going to hear people talk about, as they say, the R word more and more. But right now, I do want to go over what we are expecting this week. Now, in terms of inflation, a very important report is coming out. This is the PCE, Personal Consumption Expenditure Index. Why is it so important? It's important because this is what the Fed watches. Now, typically, when those numbers come out, they are typically a little bit better, meaning less inflationary indications than the CPI, Consumer Price Index. For example, in healthcare services, we've seen that the PCE shows it to be less of amount of prices moving higher. And even with tickets, travel tickets, airline tickets, less. So we'll watch to see this if in fact it comes down in a meaningful way from the previous PCE report and also from the CPI report. Market will be watching. And that is going to come out towards the end of the week. Today, by the way, I want to point out that we are going to hear about durable goods sales. We know that on the retail level, you and me and regular people, that durable goods orders are down. Folks have been saying that in some of the reports for a number of weeks now. We'll see how that is, how that's coming across, whether or not we're saying it, but whether or not we are actually doing it. In fact, we have seen durable goods orders come down a bit. We'll see if it has continued. But in this report that comes out this morning, what we're going to see is also business spending, and that's important because businesses have been slowing their spending. So this is going to be something that, fits into that mosaic of where we are headed in terms of the strength of the underlying economy. This week, too, we'll see pending home sales, and we will also get a report at the end of the week on Friday on construction spending, and the Institute for Supply Management manufacturing report will come out on Friday. I look at these reports very closely, especially the ISM, Institute for Supply Management. Why? Simply because we have seen manufacturing slow, new orders slow, hiring expectations slow. Remember, 50 is the level. We're going to be watching that level. Above 50 in this report shows we're still expansionary territory. Below, it shows contraction. Now, everyone always tells me, Quincy, we're not a manufacturing country anymore. We're service sector. That's true. The service sector will be next week. But the fact is, it's important. It's extremely important because manufacturing has its hands in all kinds of products that are sold by the service sector. So it is important. It gives you a trend. And at this stage, when we worry about what the Fed is doing, we want to see what the trends are. In terms of trends, before we say goodbye for this week, the trend is that we're hearing more and more Federal Reserve speakers talk about a 75 basis point hike for the July Federal Reserve meeting. So far, I've counted 3, including one who tends to be kind of dovish. That's Mary Daly of the very important San Francisco Fed. She's discussing it in general, and she's said, you know what, I could see a 75 basis point hike. What we are seeing the Fed do is to take advantage of a still strong labor market and going in and trying to extricate the notion of inflationary pressures climbing ever higher, both from the consumer and from businesses. And they seem to want to do it much more quickly. On the supply side, now remember, the Fed only deals with demand, trying to get us to stop spending as much, trying to then push prices down. trying to get us to stop buying houses. They're doing a pretty good job on that one because housing sales are down. Trying to get the prices down. That's the goal in trying to fight inflation from the demand side. But there is the supply side, which is extremely important, and we all know what we're waiting for. Here's some very good news. Prices for freight movement, they're coming down. That's suggesting that it's moving more quickly than before, that it's untangling a bit. And that's good news. And especially when we start to see it at the ports, we are starting to see some signs of containers going right onto the ships, not waiting that long. And that's on the U.S. side. Very good news. We need to see that continue. Also in China, we're beginning to see movement in Shanghai, and we expect to see factories beginning to open. Granted, people are afraid to go out. If they're caught with COVID, they get tested all the time. They've got to go into isolation, and they mean isolation. And so people are a little bit nervous about going out, but life is getting a bit more normal in Shanghai. Remember, Shanghai is a major financial center. Factories has a major port, deep sea port, which is important in the global supply chain. The more that it unwinds, the better it is for the overall global economy, because presumably then prices come down. So all of these bits and pieces that seem as though they're not related, ultimately you could connect the dots, because ultimately it will help the Fed in its push to bring down inflation, because on the other side, the supply side, prices may start to come down in a more meaningful way. So if the two connect at some point, the demand and supply side, the Fed's job is going to move much more quickly. That said, you're seeing gasoline prices come down. There's a number of reasons for this. One is that there are expectations still that the global economy, is slowing too much. Demand slows. But by the way, if it looks like it's going the other way and the global economy is turning the corner, even at the margin, you're going to see the prices start to rise. Another thing, we're in hurricane season. Anytime there is concern about a hurricane, you will see prices go up. Why is that? The reason is disruption of supply. Whenever there's even a hint of disruption of supply, gasoline prices will rise. It's just the way it is. It could be a strike in one of the big areas in the world that pumps a lot of oil and gas. You're going to see any talk of an impending strike by the workers, the prices will go up. So right now, I think people are enjoying this, the lower prices. But here's the other side of that equation, and that is the more we see prices come down, the more we're apt to fill up. So that's something to think about, right? Because we know that globally supplies are down. And Saudi Arabia, for example, the de facto head of OPEC, warning that, yes, they can up supply within OPEC, but that said, there's just not as much supply as they say that the world seems to think that they have. The president is going to go over there ostensibly to talk about Middle East peace, but there's no doubt he's going to go there and try to mend relations with the Saudi royal family, but also ask to have them pump more oil. We will see ultimately how this unfolds. But right now, Americans are taking to the roads, and even though oil prices, gasoline prices are high, they're certainly a lot better than they were a couple of weeks ago. Have a very safe July 4th, and think about our flag and think about our country. Happy 4th of July, Independence Day. Thank you so much. Get in touch anytime. Thank you.
This material was prepared by LPL Financial. It's for general information only and is not intended to provide specific advice or recommendations for any individual. There is no assurance that the views or strategies discussed are suitable for all investors or will yield positive outcomes. Investing involves risks, including possible loss of principal. Any economic forecast set forth in the podcast may not develop as predicted and are subject to change. References to markets, asset classes, and sectors are generally regarding the corresponding market index. All indexes are unmanaged and cannot be invested into directly. Index performance is not indicative of the performance of any investment and do not reflect fees, expenses, or sales charges. All performance reference is historical and is no guarantee of future results. All information referenced in the podcast is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. Securities and advisory services offered through LPL Financial, a registered investment advisor and broker-dealer, member FINRA and SIPC. Insurance products are offered through LPL or its licensed affiliates. To the extent you are receiving investment advice from a separately registered independent investment advisor that is not an LPL affiliate, please note LPL makes no representation with respect to such entity. If your financial professional is located at a bank or credit union, please note that the bank or credit union is not registered as a broker-dealer or investment advisor. Registered representatives of LPL may also be employees of the bank or credit union. These products and services are being offered through LPL or its affiliates, which are separate entities from and not affiliates of the bank or credit union. Securities and insurance offered through LPL or its affiliates are not insured by the FDIC or NCUA or any other government agency, not bank or credit union guaranteed, not bank or credit union deposits or obligations, and may lose value.